Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about TRANSUNION quarterly report. TransUnion provides a wide range of businesses and services across two segments, U.S. markets and international. The company's offerings include credit reporting and credit marketing solutions, analytics and consulting services, identity verification and authentication, debt recovery solutions, onboarding and transaction processing products, scoring and analytic products, marketing solutions, fraud and identity management solutions, customer retention solutions, insurance, technology, retail, e-commerce, telecommunications, media, tenant, employment screening, collections, and public sector-specific solutions, credit reports and scores, credit monitoring, identity protection, and resolution financial management. For consumers, the international segment offers credit reports, analytics, technology solutions, consumer services for personal finance management, credit bureaus, commercial credit information services, insurance, and auto information solutions. TransUnion's stock price has dropped by over 17% in the past year due to several key news events. The introduction of FICO's Mortgage Direct License program in October 2025 was a major contributor, allowing mortgage lenders to directly license FICO scores and bypass traditional credit bureaus like TransUnion. This move is expected to impact earnings and margins of credit reporting companies. Analyst downgrades following the FICO announcement further exacerbated the decline. Goldman Sachs lowered its price target on TransUnion's stock from $96 to $83, while Bank of America reduced its price target to $75 and maintained an underperform rating. Other factors contributing to the drop include a data breach at a third-party provider in September 2025, exposing personal information of 4.4 million U.S. customers, and concerns over credit report pricing in May 2025. These events have led to increased volatility and analyst target adjustments, resulting in TransUnion's stock price decline exceeding -17.02% in the past year. The primary drivers of revenue growth or decline can be summarized as follows. Revenue growth drivers. The acquisition of Verisk Financial contributed significantly to revenue growth. Strong performance in various geographic markets, including the United States, Canada, the United Kingdom, Africa, and India. Revenue growth was also driven by an increase in cost of services. Revenue decline drivers. A large breach revenue in 2024 had a negative impact on revenue. The prior year's one-time contract decline also contributed to revenue decline. Foreign currency fluctuations negatively affected revenue. Overall, the company's revenue growth is largely attributed to strategic acquisitions and strong performance in various markets. However, revenue decline was driven by specific events and external factors such as foreign currency fluctuations. Net income and profit margins. A shift in performance. The net income of a company underwent significant fluctuations between 2024 and 2025. For the 3 months ended September 30, 2025, it decreased by $3.9 billion, minus 71.7% change, compared to the same period in 2024. However, for the 9 months ended September 30, 2025, it increased by $6.1 billion, 23.3% change. This contrasting trend can be attributed to various factors such as accelerated technology investment and mergers and acquisitions expenses. Profit margins also experienced changes during this period. The operating income margin increased from 14.3% in 2024 to 17.7% in 2025 for the 3 months ended September 30, but decreased due to an increase in income before taxes and a decrease in EBITDA. Similarly, the net income margin rose from 6.6% in 2024 to 8.6% in 2025 for the same period, but declined due to non-recurring expenses and shifts in revenue mix. The reasons behind these changes are multifaceted, including non-recurring expenses, shifts in revenue mix, and changes in tax rates. These factors have contributed to the fluctuations in net income and profit margins, highlighting the complexities of a company's financial performance over time. The company is generating positive operating cash flow, with a significant increase from $578.5 million in 2024 to $668.1 million in 2025. This indicates a substantial improvement in the company's ability to generate cash from its core operations, suggesting a strong financial position and potential for future growth. The company's debt level and interest expenses have undergone significant changes. Notably, total debt decreased by $126.1 million from $5,147.2 million to $5,021.1 million as of September 30, 2025. This reduction in debt is accompanied by a decrease in long-term debt by $40.7 million, 0.8%, and the elimination of outstanding balances under the senior secured revolving credit facility. In terms of interest expenses, there are mixed signals. On one hand, interest expense decreased by $4.1 million for the year ended September 30, 2025. However, for the 9 months ended September 30, 2025, interest expense increased by $20.1 million, up plus 23.3% from 2024. This increase is attributed to a 10% change in term SOFR rates, resulting in approximately $6 million annual increase in interest expense. Overall, while there are some conflicting signals, the company's debt level has decreased significantly, but interest expenses have shown mixed results with both decreases and increases depending on the time frame considered. Regional performance varies widely in financial summary. The financial summary reveals significant regional disparities in performance. Canada, the United Kingdom, and Africa were standout performers, with growth rates of 9.6%, 23.8%, and 13.9% respectively on a quarterly basis. In contrast, Latin America and Asia Pacific struggled, with declines of 0.5% and 7.4% in quarterly performance. India's growth was minimal at 0.6%. Segment-wise, U.S. markets and international segments showed resilience, growing by 7.8% and 7.9% respectively on a quarterly basis. However, certain segments underperformed significantly, including verification and consulting, which declined by 16.3%, and Pacific International, with a decline of 7.6%. Management's outlook and strategy. The company is focused on accelerating technology investment to transform its infrastructure and improve efficiency. Key strategies for growth include expanding into new markets, deepening solution suites, investing in technology infrastructure, and enhancing the global operating model. Management aims to increase revenue and improve operating efficiency through strategic transactions, mergers, acquisitions, and business optimization. The company is well positioned to expand its share within existing markets and capitalize on the larger data and analytics opportunity. To achieve this, it will invest in enterprise-level costs for administrative purposes, implement a global cloud-based approach, and prioritize cost management. With sufficient cash on hand to fund operations for at least 12 months, the company is executing a transformation plan to stay ahead in the market through investments in artificial intelligence and new services. The company has demonstrated a commitment to returning value to its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has paid out $68.3 million in the first 3 quarters of 2025, with an annual cap of up to $100 million, or 10% of consolidated EBITDA. Additionally, the company has repurchased a significant number of shares, including approximately 1,260,000 and 1,711,000 shares in the 3 and 9 months ended September 30, 2025, respectively. That concludes the financial summary for TRANSUNION. Feel free to comment below, and I will be happy to answer them when possible.